Welcome to FR class by CPA Ronoh again. Let's dive in. We're doing a published account. We're doing the published account, and we started here maybe just to go back a bit. We said the published account is where you prepare the financial statement, but you give the main accounts, that is the comprehensive income statement, the balance sheet, and also the statement of cash flow, which examiner need you to do all the working separately. So if it is calculation of revenue, if there is any adjustment to do, then you will do it separate as working, then you will bring here one figure. The same with cost of sales. So we find that apart from what we normally have as a cost of sales, that is opening stocks, purchases, closing stocks, then you might get other costs being classified as cost of sales, maybe depreciation and other expenses which examiner will seem like to classify in the cost of sales. If you look at the question which we were doing it last class, that is April 2022, question 3, Millennium Limited, most of the expenses were classified as the cost of sales, especially depreciation. If you look at this note 5, we're being told that depreciation is classified as a cost of sales, except for depreciation on furniture and fitting, which is classified as administrative expense. So, which means we only have four classes of expenses. We have one as cost of sales, and then we have other as administrative cost, selling and distribution, and the finance cost. So all these expenditure you will classify in these four classes. So that one will give you now the comprehensive income statement, because after that you have to get the tax and less all these one. So this is the format. We start with the revenue, cost of sales, add other income if it is there, less expenses, admin, selling, finance cost. Then you arrive at the profit before tax, less tax, get to the profit after tax. Then you subtract any other dividends. If we have the preferred dividends and ordinary dividends, you subtract, transfer to reserves, so that you get the retained earning for the period. You add the retained earning brought forward, and then so that you can arrive at the retained earning carried forward. So that is the one of the statement you need to prepare. Thereafter, also, you are required to prepare the statement of changes in equity, where you have to prepare the ordinary shares, share premium, retained earnings, reserves, and then get the total. So you prepare this one separate. Now, these are the elements which will appear in the statement of financial position. So you will take the final figure here to the statement of financial position. The statement of financial position under the published account will not change. It's only one item which will change, that is non-current assets. You only take the cumulative figure of PPE to the published account. For example, this question we did for April. If you go to our, we did a statement of changes in equity. We did the PPE as a working, so that we took this figure to the balance sheet as one figure. You can see here. That is the only for the statement of financial position. So we don't have much changes with that. We don't have much changes. Now I want to introduce December 2024. Question 1, question 4. Question 4. Yeah, question 4. So still this is the published account. So we have been told that the farm plan has been in operation for the past 15 years, dealing in agricultural produce processing business. The following trial balance was extracted from the books of the company. as at 31st October 2024. So we have been given the revenue, income from the investment, ordinary share, retained earning, 8% loan stock, account payables, deferred tax, all these. So purchases, distribution, loan paid, leased plant, dividend paid, rent, inventory on first, that is the opening inventory, account receivable, investment, long term. Now, note number 1, we've been told as of that 1st October 2024, the inventory were valued at 43.2 million. So this is a closing inventory. So closing inventory affect which component cost? Closing inventory affect which component cost? It affects the cost of sales. So we'll have our working, we will do the working as per this additional information. So working here, our workings, number 1, we say the opening or closing stocks affect the cost of sales. So our working will be cost of sales, be cost of sales. So in cost of sales, we normally take the opening inventory, opening inventories. Opening inventory, we have it in trial balance of 37,800. We add the purchases, so we got purchases here of 78,200. We less the closing inventory. Closing inventory, which we have been given in the note there, that is 43,200, so that we can be able to get our cost of sales here. So this plus this minus this, so this is our cost of sales. As of that, we can even say this one as per the trial balance, but we'll have to check whether we have other adjustment or cost which will affect the cost of sales. So we cannot say that is the final adjustment of the cost of sales. We move on to the note number 2. We move on to the note number 2. Note number 2, we have been told the land and building were purchased on 1st November 2008. The cost of land at the date of purchase was 70 million. However, on 1st November 2023, the land and building was provisionally valued at 175 million and 80 million respectively. So that is a revaluation. The estimated useful life of the building before revaluation was 50 years. However, the revaluation did not change the useful of the buildings. Plant is depreciated at the rate of 15% per annum using the reducing balance method. Depreciation expenses are to be included under the cost of sales in the income statement. So which means the depreciation for building and the plant has to be classified under the cost of sales. So let's do that. We can have the working here still, but we will classify that cost up there. So make sure that you have enough spaces here for other costs, which you will classify there. Now for this is a revaluation, so we will say, but we can say details. And then the net book value in the trial balance, revalued amount. After getting the revalued amount, we can get either revaluation gain or loss. Revaluation gain or loss. So the first item is land. What is the net book value of land in your trial balance? Land and building at cost 270,000, but there is a cost of land here of 70,000. So the land is 70,000. We're using 3 zeros. Now this land has been revalued to 80,000. So the current revalued amount is 80. You can put 80,000, but we remember others 3 zeros. So you need to show. But nobody is marking this working. when it comes to exam, nobody is marking the workings. Now, so what is the revaluation gain? This minus this, we get a revaluation gain of 10,000. Good. Another asset is building. Let's get the net book value of building. Let's get the net book value. So the net book value for this is if you subtract 70 from 270,000, then we remain with 200. But is that 200 the net book value? No. You have accumulated depreciation here of building of 260. So we will remove the cost of land first. So 270,000 subtract 70, and then subtract the accumulated depreciation of 60,000 to remain with the net book value. So that is our net book value. That's our net book value. Then they revalued this asset to, or they revalued it by, or to 175,000. So we have a 175,000, the current value of that asset. So what is the revaluation gain? That is 35. So get this total revaluation. So this is a new revaluation. Do we have revaluation as per the trial balance, so that we get the total revaluation? So check your trial balance whether you have revaluation. Check your trial balance whether you have the revaluation or whether we have been given in this statement. Normally, yeah. So we don't have the revaluation as per the trial balance. We could have added that. So this is the final figure of our revaluation. That is the final figure of our revaluation. Now, if examiner give you the useful life, in that case, it is silent, but it's not telling you to calculate the depreciation, but back in your mind, the asset always depreciate except land. So if you have been given the useful life and the cost of the asset, then automatically you have to calculate for depreciation. So can we get the depreciation? We take the revalued amount, they revalued it to 175, but the useful life of the plant didn't change. So we still use that one. It is a straight line. So we will take 175,000 divided by 50, which is our years. So what is the value of depreciation? What is the value of depreciation? This is the depreciation for building. So it will be 175,000 divided by 50. So we get that 500 as our depreciation. We have been told all depreciation are classified on the cost of sales. So we'll have depreciation here, specifically building. Another one is plant, depreciation for plant. For plant, there is no need to do the working here. We can do it here, depreciation. Plant. They have given us 15% per annum using a reducing method. So when you hear the term reducing method, you should think of taking the cost of the asset minus the accumulated depreciation. Now, take the cost of plant, 156,000. Subtract the accumulated depreciation, 26,000. So once you do that, calculate. Really umepata ngapi? So make sure don't copy my figures. Use the calculator, get involved in the calculation. So we'll get to know how did we arrive at this figure so that you don't just copy. Ikifika time your revision, utajua hii value imetoka aje. So that is our depreciation for plant. Now we are down to it note number 2. We're down to it note number 2. Go to note number 3. On 1st November 2023, a farmland limited enter into a 5-year lease agreement for an item of plant. This item had an estimated useful life of 5 years. The annual rental, which was payable in advance with effect from 1st November 2023, was 22 million. The fair value of the plant is 92 million, and the implicit interest rate is 10% per annum. So this one is testing the concept of lease. The lease. In the last question, we did the list. Ama equal na lease. There was no lease. So here you need to prepare a lease. A lease is just a simple. It's like the amortization. You have done in financial management how to do amortization schedule and at a time value of money, which it will be the same here. So we will have a lease schedule. A lease schedule. So we will have periods of 1, 2, prints the amount or balance brought forward. Balance brought forward, you take the 92 million. 92 million. Now, for that, you take the installment. The installment is paying 22 million. So we can have the balance here. Which will be this minus that to get for us the balance. Now with here, we can get the interest. So the interest, we have been given the implicit rate, which is 10%. 10%. So get the interest of the balance. So we'll take this, multiply by 10%. Multiply by 10%. So that is our interest. That is our interest. So after getting the interest, it is 10%, yes, 10%. So we can get we can get the principal here and still get the balance. But if you know how to do it, the loan amortization also, it's simple. There's another way also which you can do it, so long as you're getting the correct interest. What matters is the correct interest, because this is what we are looking at for us to get an interest expenses, nothing else more. So maybe the principal in this case will be this plus this, balance plus that. So at the end of it here, we'll have this minus this. That one, no, 77. This is the principal. You took and actually even there is no need for us to get this one, because you got the balance, the installment, you got the balance, you got the interest. So the principal will be the balance plus the interest. So at the end of it, this is what you will have it here. And the installment will remain the same. That is 2200. So our balance will be that one, get the interest, which will be 55. So here should have 60. So there's no need to do a lot of working. What is more important for us is the interest. What is more important for us is the interest and the balances, and also the installment. So that's what we are looking for this. So we got interest is the finance cost. Interest is the finance cost. So did we have finance cost somewhere else? No. So we can't have a finance cost here. Remember, finance cost is the one of the component. Finance cost. So you will take as per the trial balance. Do we have anyone which have been given in the trial balance? So as per the trial balance, do we have the finance cost as per the trial balance? Let's check. 8% loan stock can give us the total interest we are going to pay with this loan. So get 8% of the loan. What is the value of the loan? What is the value of the loan? 50,000. Was this loan covering the entire full year? So let's check whether there is a note which explaining whether this loan was covering the entire period. Note number 4. The loan 8% stock was issued on 1st January 2024. It was issued on 1st January 2024. So don't mind with how they paid. What is more important is the date of issue. So with the date of issue, can be able to calculate the number of months covering this loan stock. Now, when are we closing our books of account? That 1st October 2024, which means we open, or our opening period is 1st November 2023. Now we are issuing on 1st January 2024. January, February, March, April, May, June. So up to May, up to June, that is 6 months. July, 7 months. So 9 months, 1st October, that first, up to that 1st October. In 9, how many? 10. 10 months. So multiply by 12 over 12, yeah. So that one will give us the total interest, which you will have to account as an interest cost. Now, so that, but before we look at whether there is an accrual, that is the finance cost as per the trial balance. We have the lease cost, which one are we accounting for the lease cost? We are accounting an interest, which is 1 year. Remember, expenses, you only account for one financial period. You cannot account expenses for more than 2 financial periods. So our interest here is 7,000. So we got a 7,000 interest here, which if I add the 2, so I can get my total, my total finance cost. Yeah, so that is my total finance cost, which I will take to my P&L. But now with this finance cost, we need to calculate accruals. How much did they today, or how much they have paid for this finance cost of the loan stock? Remember, this is the entire interest which you will charge as an expenditure. But now we need to check what they have paid so that you can be able to know whether we have accruals. So if you go back to your trial balance, we had saw something relating to loan interest paid. So they paid 2,000. So which means we can't have interest paid here. Interest paid of 2,000. So what is accrued interest? We are looking for accrued interest. Accrued interest will be the total interest, which is 33 minus what they paid. So this is accrued interest, which we will take to the balance sheet under the accrual. Then we are done with note number 3. Kuna mtu anapata, I'm doing very fast, I'm explaining very fast, you are not getting any explanation of the notes, or if there is any clarification you need from these two notes, note 1 and 2, you can ask. So
where are we getting the accrued interest?
The accrued interest, we have the total interest to be paid per year, which is 3333, right?
Yes.
If you check the trial balance, how much have they paid as an interest?
2,000.
2,000. So the balance of these ones, so the different is what we call the accrued interest. They have not paid this one.
Okay.
Yeah. Now, we move to note 4. 8% note 4, we have done with that. So we go to note 5. The income tax for the year ended at 1st October 2024 is estimated to be 28.3 million. The deferred tax provision as of that 1st October was to be increased to, you have to be keen, was to be increased to, not increased by. So this note 5, what are we looking at for this note 5? If you go back to, and that's why I said you should be always revising. If you go back to the topic of accounting for the income tax, IAS 12, we talked about the deferred tax, and we said we got the deferred tax liability and the deferred tax asset. If which it's come on the different of or as a result of temporary difference, maybe because of a different accounting system, accounting and the tax laws. So when deferred tax liability increases, that is an expenses or it is a tax that you need to pay. If a deferred tax liability increases, it is a tax that you need to pay. And we have been told here it was increased to. So which means the deferred tax liability increases. So it is an expense to us, not an income. So it is an expense. So I will put that note number, you can call it number 4. We got the current, we got the deferred tax. The deferred tax increased to, so they have increased to 14,100. How much do we have in our trial balance? So we are looking for that increased element. We are looking for that increased element. So subtract with what you have in your trial balance as a deferred tax. So if you go back to your trial balance, we got a deferred tax of 12,500. So I will subtract 12,500 to give me an increase in deferred tax. So this increase, because we said an increase is a liability which you have to pay. So we will add the current tax for the period. So say add current tax. How much is our current tax? Have we been given the current tax? The income tax for the year was estimated to be 28,300. That is our current income tax. So add the 2. So this is the total income tax we will charge in the P&L. In our P&L. I don't know if we omit decimal. I don't know whether it will match. Okay, check. So we are done with all the notes. I didn't see any note attaching the revenue. So what is remaining now is to prepare our published account for Farmland Limited. Farmland Limited, we start with the revenue. Once you have done with the working, the other one is very easy. It is just posting or copy pasting. Oh, we did distribution and selling. Do we have admin cost? I didn't see any working for that. So get the total cost of sales, because that is the only, these are the only cost we need here. Or is there, oh, depreciation on leased asset. These assets also do depreciate. The moment you have been given the useful life, 5 years, remember that one do depreciate. So get the depreciation for this lease, and we have been told all the depreciation is classified under the cost of sales. So we got depreciation for a leased plant, which will be 92 million divided by the useful life, 5 years. So get the depreciation. Get the depreciation. So that is the depreciation. So we got now the total cost of sales. So this is our total cost of sales. Which we will have revenue, which is 278,400. We will have cost of sales. Cost of sales is this one. Subtract to get the gross profit. So that is our gross profit. Or we have any other which we'll have to classify under the cost of sales. Nishafanya zote: building, depreciation, land. Do we have anything which we need to capture there? Okay, seeing it. So let's move on. Add other income. So for incomes, if you look at here, there was something investment income, 4,500. So get the total income. So you will join after 1 minute itaisha. So less expenses. Expenses, we can start with whatever they don't have working. Distribution expense of 10,000. We have administrative expense, 500. Finance cost,